Something strange just happened in the stock market today. The US just released its June jobs report, and it was bad. Really bad. Only 57,000 new jobs were created, about half of what economists expected. Normally, that kind of news should scare investors. Instead, the Dow Jones hit a record high, closing above 52,900 points for the first time ever. So here's the real question. If the economy is getting weaker, why is the stock market going up? Stick with me, because by the end of this video, you'll understand exactly how Wall Street thinks and why bad news can actually be good news for your portfolio. Let's break down what actually happened. The US economy added only 57,000 jobs in June, missing forecasts by a wide margin. Meanwhile, private payroll data also came in weak, with companies adding fewer jobs than expected. On the surface, this looks like a warning sign, a classic recession signal. Fewer jobs usually means people spend less, companies earn less, and stock prices should fall. But here's the twist. The unemployment rate actually ticked down slightly, and wage growth stayed steady. So this isn't a full-blown crisis. It's what analysts are calling a Goldilocks economy. Not too hot, not too cold. Here's the part most beginners miss. Investors aren't just reacting to the economy. They're reacting to what they think the Federal Reserve will do next. When job growth slows down, it usually means inflation pressure is easing too. And when inflation cools, the Fed has more room to cut interest rates. Lower interest rates are like fuel for the stock market. They make borrowing cheaper for companies, boost corporate profits, and make stocks more attractive compared to savings accounts and bonds. So when traders saw a weak jobs report, they didn't think recession. They thought, this might push the Fed toward rate cuts, and stocks rallied on that hope. This record high didn't come out of nowhere. 2026 has already been one of the strongest years for the stock market in recent memory. In the first half of the year alone, the Dow gained nearly 9%, the S&P 500 rose close to 10%, and the Nasdaq climbed over 12%. Even small-cap stocks tracked by the Russell 2000 surged by more than 20% to drive their best first half since 1991. So this jobs report didn't create the rally. It simply added fuel to a market that was already running hot. Now here's something most news channels aren't covering enough. While the Dow was hitting records, chip stocks and AI-related companies were actually falling. Big names like Micron and Applied Materials dropped nearly 10% in just a few days. Why? After an incredible run fueled by artificial intelligence hype, investors are taking profits and rotating money into safer, more traditional companies, banks, industrials, and consumer brands. This is called a market rotation, and it's a healthy sign. It means the rally isn't just riding on a handful of tech giants anymore, it's spreading across the entire economy. So what should you actually take away from all this? First, a weak jobs report doesn't automatically mean a stock market crash. Markets often price in expectations about the Fed, not just current conditions. Second, keep an eye on inflation data and upcoming Fed meetings. They matter more right now than jobs numbers alone. And third, don't panic sell or panic buy based on a single headline. The real story is always bigger than one data point. The economy is sending mixed signals right now, weak jobs, but a record stock market. That contradiction isn't a mistake. It's exactly how markets work. They trade on the future, not just the present. If this video helped you understand what's really going on with the US economy and stock market in 2026, hit like, subscribe for more finance breakdowns, and drop a comment. Do you think this rally can last, or is a correction coming? See you in the next video.